On March 6th, 2026, the largest asset manager on the planet did something it has never done before. BlackRock, which manages over $10 trillion in client assets, told investors in its $26 billion private credit fund that they could not have their money back. Investors had requested $1.2 billion in withdrawals. BlackRock returned only $620 million. The rest, roughly $600 million, was frozen, locked, inaccessible. The investors who put their money into what was sold as a semi-liquid investment product were told, for the first time in the fund's history, that the exit door was shut, and BlackRock was not alone. The same week, Blackstone, the world's largest alternative asset manager, faced record withdrawal requests from its $82 billion private credit fund called Beak Red. Investors demanded $3.8 billion back, 7.9% of the fund's total assets. That was so large that Blackstone's executives had to personally inject $400 million of their own money into the fund just to meet all the requests. The firm's president, John Gray, went on CNBC and called the panic a ton of noise. But when the president of an $82 billion fund has to write a personal check to stop a run on his own product, that is not noise. That is a five-alarm fire dressed up in a suit and tie. Then Morgan Stanley disclosed that investors in its North Haven private income fund had requested the redemption of 10.9% of shares. Then Cliffwater, which manages a $33 billion flagship private credit fund, received requests to withdraw 7%. And Blue Owl Capital, managing over $300 billion in total assets, did something even more radical. It permanently killed quarterly redemptions for its $1.6 billion OBDC2 fund. Not temporarily suspended, permanently eliminated. Investors in that fund are now effectively trapped in a slow-motion liquidation with no regular exit. 5 of the largest financial institutions in the world, all within weeks of each other, all restricting freezing or eliminating investor access to their own money. Fortune magazine called it a $265 billion meltdown. Morningstar warned of a prolonged cycle of negative net outflows that could last up to 2 years. Former PIMCO CEO Mohamed El-Arian publicly asked whether this was a canary in the coal mine moment. And Verda Capital founder Dan Rasmussen went further and said, "The private markets bubble is finally starting to burst. This is not a theoretical risk. This is happening right now, to real people, with real money, at the largest financial institutions on earth. And almost nobody is talking about it because the world is focused on the war and the oil shock and the stock market. But underneath all of that, in the shadow banking system that holds nearly $2 trillion, the locks are clicking shut on investor accounts one by one. Let me explain exactly what happened, why it is going to get worse, and what it means for your money even if you have never heard of a private credit fund in your life. First, let me explain what these funds actually are, because the story of how ordinary investors got trapped in them is one of the most important financial narratives of the last decade. After the 2008 financial crisis, new banking regulations called Basel III restricted how much risk traditional banks could take. Banks pulled back from lending to mid-sized companies, and Wall Street saw an opportunity. Firms like Blackstone, BlackRock, Apollo, KKR, Ares, and Blue Owl created a new type of investment vehicle called a business development company, or BDC. These BDCs raise money from investors, primarily from retail investors, regular people with investment accounts, and use it to make loans to mid-sized companies that can't easily borrow from banks. The pitch was irresistible. These funds offered yields of 9 to 11% at a time, when savings accounts paid near zero. They called it the democratization of private equity. Regular people could now access the same high-yield investments that pension funds and billionaires used. The money poured in. The private credit industry grew from a few $100 billion to over $1.9 trillion. BlackRock acquired HPS Investment Partners for $12 billion to get into the game. Blackstone built BC Red into an $82 billion giant. Blue Owl gathered over $300 billion in total assets, with roughly 40% coming from individual investors. But here is what the sales pitch did not emphasize. These loans are illiquid. They cannot be sold quickly on a market. There is no stock exchange for private credit. When you buy shares in one of these funds, you are essentially locking your money into loans that last 5 to 7 years. The funds offer quarterly redemption windows, typically capped at 5%, meaning even in normal times, only 5% of investors can get out in any given quarter. And that structure only works when more money is flowing in than flowing out. When the inflows exceed the outflows, the fund can pay redemptions easily because new investor money covers the departures. But when the tide turns, when more people want out than want in, the fund hits a wall. It cannot sell the loans fast enough to pay everyone. So it gates, it freezes, it tells you, sorry, you cannot have your money right now. That is exactly what happened on March 6th. And the trigger was a perfect storm of 3 simultaneous crises that nobody saw coming at the same time. The first crisis is AI disruption. 19% of BlackRock's HLN portfolio is invested in software companies. Roughly 25% of Blackstone's BCRD portfolio is in software. These were supposed to be the safest borrowers in private credit. Recurring revenue, high margins, predictable cash flows, perfect collateral. But in late January, when new AI capabilities demonstrated that they could replicate core functions of traditional enterprise software, the entire software sector collapsed. The iShares software ETF dropped over 20% year to date, 9% in February alone. Jefferies coined the term SaaS-pocalypse, and UBS published an analysis warning that under an aggressive AI disruption scenario, private credit default rates could surge from under 3% to 13%. Then came NVIDIA's earnings on February 26th. The company posted the largest and cleanest earnings beat in semiconductor history, according to Morgan Stanley, and the stock still fell 5%. Because the market was no longer celebrating AI growth. It was terrified of AI disruption. The very technology that was supposed to make these software companies more valuable was instead threatening to make them obsolete. Block, the payments company founded by Jack Dorsey, fired over 4,000 employees, half its entire workforce, to replace them with AI. That was not a hypothetical. That was a Fortune 500 company cutting half its humans in a single announcement. Suddenly, the loans inside these funds did not look so safe anymore. The software companies that were borrowing at premium rates now faced the possibility of their entire business model being disrupted by artificial intelligence. Their recurring revenue could evaporate if customers switched to AI alternatives. Their high margins could compress as competitors deploy AI to undercut pricing. Their predictable cash flows could become unpredictable overnight. PitchBook data shows software accounts for roughly 17% of BDC portfolios by deal count, second only to commercial services. That is hundreds of billions of dollars in loans to companies whose fundamental business model is now under existential threat. And the investors who owned shares in the funds started heading for the exit. The second crisis is the Iran war and oil shock. When oil spiked from $70 to $120 in 10 days, the economic outlook changed overnight. Higher energy costs mean higher operating costs for every company in these portfolios. Higher inflation means the Federal Reserve stays frozen, unable to cut rates. And if the Fed cannot cut rates, the floating rate loans that make up the bulk of these funds remain expensive for borrowers, increasing the risk of defaults. The Bank Treasury Risk Management Institute published an analysis recommending that financial institutions stress test for stagflation, which can result in banks facing credit, interest rate, and liquidity stress simultaneously. They warned that higher energy prices imply greater demand for dollars in the global financial system and urged institutions to ensure on-balance sheet liquidity is adequate. The oil shock did not just hurt consumers at the gas pump. It fundamentally altered the credit risk profile of thousands of mid-market borrowers sitting inside these private credit portfolios. A mid-sized manufacturing company that was comfortably servicing its private credit loan at $70 oil might be struggling at $90. At $100, it might be in distress. At $120, which oil briefly hit this week, it might be considering default. And the funds holding those loans cannot simply sell them to raise cash for redemptions. There is no liquid market for these assets. They are stuck with deteriorating loans while investors are pounding on the door demanding their money back. And here is the vicious cycle that almost nobody understands. When a private credit fund gates redemptions, it sends a signal to every other investor in every other private credit fund. If BlackRock is gating, maybe I should get out of my fund before it gates too. So redemption requests surge across the entire sector. Morningstar documented exactly this pattern. After BlackRock's announcement, requests spiked at Blackstone, Morgan Stanley, Cliffwater, and multiple other funds. The gating itself creates the panic that leads to more gating. It is a self-reinforcing doom loop. And once it starts, it is extremely difficult to stop because confidence, once lost, takes years to rebuild. The BTRM analysis was even more explicit about the risks. They wrote that higher oil prices and inflation require that banks lend more in nominal terms to maintain the same real value of credit in the economy. And they warned that policymakers often fail to understand how inflation tightens financial conditions until it is too late. In other words, the combination of an oil shock, rising inflation, and elevated interest rates creates exactly the kind of environment where hidden financial vulnerabilities get exposed. And private credit is the biggest hidden vulnerability in the current financial system. The third crisis is the cyber threat. And this one connects directly to the banking system in a way that should concern every American with a checking account. On March 12th, Iran's military command publicly named U.S. and Israeli-linked banks as military targets, not cyber targets, military targets. American Banker reported that this shifted what had been a generalized cyber alert into an explicit state-level declaration of intent. Credit rating agency Morningstar DBRS cautioned that Iran could increase its cyber attacks against Western entities, including banks. and Palo Alto Networks' Unit 42 Cyber Threat Intelligence Team issued specific tactical recommendations to financial institutions, including storing critical data offline disconnected from the network, implementing out-of-band verification for requests received through external channels, and considering geographic blocking of internet traffic from high-risk regions. Let me explain why this matters more than most people realize. Iran has one of the most sophisticated state-sponsored cyber warfare programs in the world. In 2012 and 2013, Iranian hackers launched distributed denial of service attacks against major U.S. banks, including JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo, disrupting online banking services for millions of customers. Those attacks were relatively crude. The capabilities have advanced enormously since then. And this time, the motivation is not just geopolitical posturing. The U.S. and Israel struck Iran's Bank Sepah, the financial institution responsible for paying the Revolutionary Guard. Iran views attacks on its banking infrastructure as military escalation that justifies symmetrical retaliation. The U.S. and Israel have also attacked Iranian oil facilities, igniting fires visible across Tehran. Iran's foreign ministry spokesman explicitly claimed that the U.S. was after Iranian oil reserves and aimed to weaken and divide Iran. In that context, Iran's declaration that U.S. banks are military targets is not bluster. It is a strategic doctrine of reciprocal escalation. You attack our financial infrastructure, we attack yours. During the 12-day war between Israel and Iran in 2025, Israel reportedly conducted cyber attacks that shut down Iran's commercial banking sector for a short period. Iran demonstrated the capability and now has the stated intent to retaliate against American financial infrastructure. PBS reported that Iran-linked hackers have been taking aim at U.S. and other targets, raising the risk of cyber attacks during the war. The cybersecurity firm, Unit 42, is now issuing real-time advisories to financial institutions, which is something that does not happen during normal times. It happens during active threat environments. Now here is what a successful cyber attack on a major U.S. bank would look like for you personally. It would not mean your money disappears. FDIC insurance protects deposits, but it could mean your online banking goes down for hours or days, your debit card stops working, your automatic bill payments fail, your payroll deposit is delayed, your Zelle transfer does not go through. In a worst-case scenario, a ransomware attack could encrypt a bank's systems and require days to restore from backups. During that period, millions of customers would have no digital access to their accounts. This is not science fiction. In 2023, ICBC, the world's largest bank by assets, was hit by a ransomware attack that disrupted U.S. Treasury market operations. In 2024, Change Healthcare was hit by an attack that disrupted payment processing for thousands of healthcare providers for weeks. These events happened to major institutions. And right now, the threat level against U.S. banks is at its highest point since the global war on terror. Now let me connect all of this to your money. Because even if you do not own shares in BlackRock's H-Lend or Blackstone's BCRED, the contagion pathways are real, and they lead directly to the financial products you probably do own. Here is how. Private credit funds are deeply interconnected with the traditional banking system. Banks provide credit facilities to these funds. Banks distribute these products to their wealth management clients. Banks hold assets that are correlated with the same companies that private credit funds lend to. When private credit funds gate redemptions, the financial advisors who sold those products to clients lose credibility. Those clients then start questioning their other holdings. They pull money from equity funds. They pull money from bond funds. They move to cash. The selling pressure ripples outward from the shadow banking sector into the traditional financial system. Bloomberg reported on March 8th that Wall Street's largest alternative asset managers are deciding between blocking exits and dealing with blowback or honoring requests at the cost of their investment principles. BlackRock's stock fell 8.3% in a single day after the gating announcement. KKR, Ares Management, and other alternative asset managers also tumbled. The entire alternative asset management sector is experiencing its worst start to a year in a decade. The Modern Diplomacy analysis highlighted the deeper systemic risk this week. The rapid expansion of shadow banking, financial intermediaries operating outside traditional banking regulation, has created a network of dependencies that regulators do not fully understand. Private credit funds manage over $1.9 trillion globally. Many of them use leverage. Many borrow from banks to amplify their lending, and many hold assets that are difficult to value in a crisis because there is no public market to establish prices. The Financial Stability Board warned that highly leveraged hedge funds using repurchase agreements in government bond markets could create systemic vulnerabilities during periods of market stress. We saw a preview of this in March 2020 when the Treasury market nearly seized up, and the Fed had to inject trillions in emergency liquidity. We saw it again in September 2022 when UK pension fund leverage nearly crashed the British bond market. and the Bank of England had to intervene within hours. And we are seeing the early stages of it now, as private credit funds gate redemptions, while oil shocks and geopolitical uncertainty create exactly the kind of multidimensional stress that exposes hidden leverage throughout the financial system. Let me give you a historical parallel that explains why this matters so much. In 2007, two Bear Stearns hedge funds that invested in subprime mortgage securities froze investor withdrawals. At the time, the broader financial media treated it as an isolated event, a contained problem in a niche market. The funds collectively held about $1.6 billion, tiny compared to the overall financial system. But those freezes were the first visible crack in a structure that was rotten throughout. Within 18 months, Bear Stearns itself had collapsed. Lehman Brothers had gone bankrupt, AIG had been bailed out, and the global financial system had come within hours of complete seizure. I'm not saying we are in 2007 again. The banking system is better capitalized, the regulatory framework is stronger, and the specific assets are different. But the pattern is identical. An obscure financial product that nobody outside Wall Street fully understands begins showing stress. The people running the funds tell investors it is contained. The stock prices of the firms managing the products crash, and the interconnections between the stressed sector and the traditional banking system turn out to be deeper and more complex than anyone realized. Private credit in 2026 is structurally similar to subprime mortgage securities in 2007 in one critical respect. Both were sold to retail investors as safe, high-yielding alternatives to traditional investments. Both depended on continuously favorable economic conditions to perform as promised, and both began cracking when the underlying economic assumptions changed faster than the portfolios could adapt. S&P's baseline projects approximately 6% default rates for private credit in 2026, up roughly 2 percentage points from historical averages. But UBS's aggressive scenario pushes that to 13%. The gap between 6 and 13% depends almost entirely on how fast AI adoption disrupts the software companies that make up the largest sector in private credit portfolios, and how long the oil shock persists. If both headwinds intensify simultaneously, which is exactly what is happening right now, the losses could be staggering. And unlike stocks, which you can sell in seconds on a public exchange, private credit assets can take months or years to liquidate. The money is not just at risk, it is at risk and inaccessible. So what should you do? Because the people who understand what is happening have a very specific playbook. And the people who do not are the ones who end up frozen out of their own accounts. First, understand where your money actually is. If you have investments through a financial advisor, a wealth management platform, or even some retirement accounts, ask explicitly whether any of your holdings are in private credit, BDCs, non-traded REITs, or other semi-liquid alternative vehicles. These products were aggressively marketed to high net worth and mass affluent investors over the past 5 years. Many people own them without realizing it. If you are in one, understand the redemption terms, know the gates, know the lockup periods, and consider whether you want to submit a redemption request before the next quarterly window closes, because the queue is getting longer every week. Second, prioritize FDIC insured deposits. Your traditional bank account, checking and savings at an FDIC insured institution, is protected up to $250,000 per depositor per bank. This insurance has held through every crisis since it was created in 1933. It held through 2008. It held through the regional bank failures of 2023. Even in a scenario where Iran successfully executes a cyber attack against a major U.S. bank, which cybersecurity experts say is a real but manageable risk, your FDIC-insured deposits are backed by the full faith and credit of the United States government. However, and this is critical, FDIC insurance does not cover investment products. It does not cover private credit funds. It does not cover BDCs. It does not cover brokerage accounts. If your money is in a product like BlackRock's HLEND and it gets gated, the FDIC cannot help you. That money is subject to the fund's redemption terms, not federal deposit insurance. Understanding this distinction could be the single most important financial insight you take from this video. Third, diversify your banking relationships. Cybersecurity experts are recommending that individuals maintain accounts at more than one financial institution. If one bank experiences a disruption from a cyber attack or technical failure, having accounts at a second institution ensures continued access to cash. The U.S. government just ordered its own employees to store critical data offline and implement backup verification systems. Apply the same logic to your household finances. Fourth, maintain physical cash reserves, not a bunker full of money, a reasonable amount. Financial preparedness experts generally recommend having enough physical cash to cover 3 to 7 days of essential expenses, enough to buy groceries, gas, and medication if electronic payment systems experience any disruption. ATMs and point-of-sale systems depend on network connectivity. Cash is the backup that works when networks do not. Fifth, move excess savings into the highest yield FDIC-insured accounts available. High-yield savings accounts are currently paying up to 5%. Treasury bills yield 3.7% and are backed by the U.S. government. Every dollar earning 5% in a high-yield account is a dollar that is not trapped in a semi-liquid alternative investment product. Sixth, consider your precious metals allocation. Gold has no counterparty risk. It cannot be gated. It cannot be frozen. It cannot be hacked. It cannot be subjected to a redemption queue. When BlackRock tells you that you cannot access $600 million of your own money, gold in your possession does not have that problem. When Iran declares American banks as military targets, gold sitting in your safe deposit box or your home safe is not affected. When a private credit fund activates its 5% redemption cap, physical gold has no cap. You own it. You hold it. You access it whenever you want. Gold is trading around $5,170 per ounce. It hit $5,400 during the initial Iran war panic. JP Morgan forecasts $5,055 for year-end. Goldman Sachs targets $5,400. Deutsche Bank says $6,000. Every major financial crisis in the last 50 years, without exception, has driven gold significantly higher. The 2008 crisis, the European sovereign debt crisis, COVID, Russia-Ukraine, and now this. 5 to 15% of your portfolio in physical gold, gold ETFs, or precious metals IRA provides insurance against exactly the kind of systemic financial stress that is unfolding right now. It is the one asset class that exists entirely outside the system that is currently breaking. And seventh, pay attention to the next 2 weeks. Morningstar reported that fund managers' redemption windows will expire soon, providing a clearer view into the severity of cash-out pressures. Independent advisor Mark Goldberg warned that private lenders have already entered a prolonged cycle of negative net outflows that could last up to 2 years. If he is right, the March freezes were just the opening act. Now, let me address the question directly. Are traditional banks next? The honest answer is that the direct risk to FDIC insured deposits at traditional banks is low. American banks are far better capitalized than they were before 2008. Stress testing requirements are rigorous, and the FDIC insurance fund provides a genuine backstop that has never failed. But the indirect risks are real and growing. The oil shock is straining borrowers. The economy lost 92,000 jobs in February. Inflation expectations spiked to 4.2%. Credit card delinquencies are at a decade high. $1.13 trillion in credit card debt at average rates above 21%. The personal savings rate is just 3.5%. 59% of Americans are uncomfortable with their emergency savings level. And now the private credit sector, which has been absorbing exactly the kind of mid-market lending risk that banks used to hold, is showing cracks. If private credit funds continue to gate, they stop making new loans. If they stop making new loans, the companies that depend on them for financing face a credit crunch. If those companies default, the losses flow back through the financial system in ways that are difficult to predict. And here is a detail that connects the private credit crisis directly to traditional banking. Many banks have credit facilities with private credit funds. They lend money to these funds, so the funds can then lend to companies. If the funds start experiencing losses and can't repay the banks, those losses move from the shadow banking system onto bank balance sheets. Additionally, some banks have invested their own capital in private credit vehicles. And many banks distribute these products to their wealth management clients. When those clients get gated and lose confidence, they do not just pull money from the private credit fund. They reassess their entire relationship with the bank. They move deposits. They close accounts. They switch advisors. The reputational contagion can be as damaging as the financial contagion. The 2023 regional bank crisis started with a single institution, Silicon Valley Bank, and spread within days to Signature Bank and First Republic. It happened because of concentrated interest rate risk that regulators had not adequately monitored. The current private credit crisis involves concentrated exposure to AI-vulnerable software companies in a $1.9 trillion market that operates largely outside traditional banking regulation during an oil shock that is rewriting the global economic outlook, while a hostile state actor has publicly declared American financial institutions as military targets. The parallels are not exact, but the pattern of hidden risks suddenly becoming visible is unmistakable. And every time that pattern has emerged in the last 20 years, the official narrative was the same. It is contained. It is noise. There is no systemic risk until there was. Larry Fink, the CEO of BlackRock itself, said recently that today's economic anxiety stems from people increasingly feeling like capitalism is not working for them. When the CEO of the company that just froze $600 million in investor withdrawals says the system is not working for regular people, that is not an abstract philosophical observation. That is a confession delivered in real time. 5 firms froze or restricted investor access to billions of dollars within weeks of each other. That is not noise. That is a pattern. And patterns in finance tend to accelerate before they resolve. The next 2 weeks will tell us whether this is a contained stress event or the opening chapter of something much larger. If this video showed you a financial crisis unfolding in plain sight that almost nobody is covering, hit subscribe right now. Because what happens as Q2 redemption windows open will determine whether the gates keep closing or start to reopen. Every week, we follow the money. We read the filings that nobody reads. We connect the dots between the shadow banking system and your bank account. And we give you the strategies to protect yourself before the headlines catch up to the reality. Share this with someone who has money with a financial advisor and does not know if they are in these products. Share it with someone who needs to understand that FDIC insurance covers their bank account but does not cover their investment account. Share it with someone who heard about the oil shock and the stock market drop, but has no idea that the largest asset managers on earth are simultaneously freezing billions in client accounts behind closed doors. The freezes are real. The gates are closing. The cyber threats are escalating. And the $1.9 trillion shadow banking system that was supposed to be the safe, high-yield alternative to traditional banking is cracking under the weight of AI disruption, an oil shock, and a war that shows no signs of ending. The only defense is knowing where your money actually is, understanding the difference between insured deposits and uninsured investment products, and positioning yourself on the right side of the gate before it closes. I will see you in the next one. Stay sharp, stay positioned, and stay ahead.